Testing. How's our audio? Testing. Our audio seems good. Okay. Hey, Hokage, hope you're doing well. Thanks for giving me the thumbs up on the audio. Okay. By the way, Hokage, I got a video coming out this weekend. It might be a little bit late because things are moving very quickly. Little update on our cannabis investments. I don't know if you've been keeping up with any of the news, but there's some pretty exciting possibilities right now in the world of cannabis stocks. So, have you been keeping up? Let's see. Oh yeah, the cannibal stocks. Yes, they are. They are nice. I am also a huge fan of the cannibal stocks, so I think you're gonna like this one. Although this one is a little bit. This one's not so mainstream. This one's a little bit out there, but you know me. Lately, I've been looking at the small cap, low volume stocks. So, but yeah, the cannabis stocks are looking pretty good right now. They've been popping quite a bit lately. There's been a lot of movement out of the Trump administration about rescheduling. And so anyway, look forward to that video. Although I hope it's not late. I may have to do like a last minute addition to that video before I release it if some news comes out tomorrow, which it likely will. So we'll see. But anyway, let's go ahead and start this video. All right, cannibal stocks. MSOS running nonstop. New Lake Capital, Green Thumb 2. What do you think of Tilray? Tilray, my understanding is that it is popping a lot because it has access to volume, whereas New Lake Capital, Green Thumb, they are OTC tickers. So they don't get near as much volume as Tilray. The last time I looked at Tilray, it didn't look as promising to me as Green Thumb or New Lake, but a lot of times when we see like really big news in the short term, at least the stocks will move not necessarily in line with their intrinsic value or how strong the business is. A lot of times there's other factors that really push the short-term movements. And so Tilray has been moving a lot. And I'm not saying I could necessarily explain 100% of why it's moving so much, but I think that has a lot to do with it. Hold on. Tilray Brands. What exchange? Yeah, because Tilray is on the NASDAQ. So I think being on the NASDAQ, it gets a lot of bonus. Canada, US, Europe, Middle East, Africa, and internationally. I'm not sure what percentage, as far as like of their total revenue, that they are exposed to the US. So that's another thing to consider. But I think most of their pop is coming from, just the fact that they are, 55.9% in the last 5 days because of them being on the NASDAQ. GTBIF. But I digress. I'm getting distracted here. I could definitely talked quite a bit about these. Oh, and Green Thumb also moved quite a bit. So New Lake, that's another story. But okay, let's get to the video. All right, what are cannibal stocks? I love investing in cannibal stocks. These are companies that are eating their own shares. They are buying back shares, and this graph shows the effect that it has on their earnings multiple. So when a company buys back 50% of its shares, even if it's making the same exact profits every year, its earnings per share is doubled. When it buys back 80% of its shares, it's now 5x. And then it only has to buy back the next, 10%, going from 80 to 90, it goes 10x and then 20x, 50x, 100x. You get the idea. The earnings per share drastically increases as companies are scooping up their own shares. So that is one thing that I like. It's comparable to dividends, except with the share buyback, you do not have to pay taxes on the share buyback. And generally, when a company is doing a lot of share buybacks, they're signaling that they believe that their share price is undervalued. Now, that's not to say companies don't make mistakes. Sometimes companies will do share buybacks for the wrong reason, even when they're not undervalued. It would be better for them to just return it to shareholders in the form of a dividend. But some companies will do that, and then not in an ideal way, but generally speaking, this is a signal to investors that the stock is undervalued. So this is one aspect of the company I'm looking at today. The second aspect is small companies that are low volume. So lately I have been searching for value in the small cap realm, specifically with companies that have very low volume, because this does not allow big money to enter. When a company is incredibly small, so like in this case, this is a $300 million company, this top one. If a hedge fund wants to take a non-controlling position, then they have to own, I want to say it's less than 10%. That means they can only put 30 million into this company. If some of the big hedge funds out there, if they have billions of dollars that they're trying to invest, it just doesn't make sense for them to make $30 million investments. Doing all of the work and only getting to do 30 million means that they have to do tons of work and make tons of investments. They'd rather have, a lot of times, they'd rather have 10 to 20 companies in their portfolio and put bigger bets on those higher conviction companies. So another problem with a company like this is its average volume is only 21,000. So that means it takes a very long time for you to build a big enough position in a company like this, because if you try to buy so many shares that it increases the average volume, it ends up pushing the share price up. And now, you can't invest at the low price that you wanted to invest at, because the very act of buying your shares pushes the price up. And now you're getting a bad deal when you buy, and then when you go to sell, there's not enough volume for you to exit your position. So it makes it very difficult for big hedge funds. It makes it difficult for big money to swim in the shallow waters. The big fish cannot swim in the shallows. So there's less competition for people like me. So I've been looking at these small cap companies, and I've got my filter set up here for average volume under 100K, price to book under 2, operating income growing over the last 5 years, small cap, projected revenue growth. I do not have that set to anything, because with these small, low volume companies, a lot of times analysts are not making predictions on them. And so you can't really screen by projected revenue. So I had to take this one off. And then finally, debt to equity under 2%. I don't want a huge amount of debt risk. So I'm going through all these companies one by one, doing free cash flow evaluations, made it all the way to the bottom before I found one that really caught my attention. WRLD. This is World Acceptance Corporation. What a name, right? World Acceptance. What does this company do? World Acceptance Corporation engages in consumer finance business in the United States. The company offers short-term installment loans, medium-term loans, larger installment loans, credit insurance, ancillary products. It also provides income tax prep. This is generally for people who have limited access to other sources of credit. So people with bad credit scores. Seems pretty risky. So where this company comes in is they don't just screen people out based on the typical bad credit score or whatever. They dig a little bit deeper. They do more due diligence into people and try to find underserved people who they are confident can actually pay back the loan despite whatever aspect there is about them that scared other traditional banks or people who would generally loan money, scared them away. So world acceptance. They are accepting the world. They are loaning money to the world. And so what we see with we'll say a higher risk loan bank or financial institution is that they will have greater provisions for losses on loans. So that is how they are accounting for it in their financials. And so we're going to look at that, how they're accounting for their loan losses and how it's a little bit volatile. But despite that, this company is incredibly undervalued. So the first thing I want to look at with World Acceptance Corporation, let's go to their financials. And just to get an idea, actually, let's go to this page right here. Oh, wait, no, sorry, this page right here. This is on their consolidated statement of cash flows from their 2024 earnings report. This is their annual report. And so in 2024, on their cash flow statement, they had a net income of $77 million. That was their net income, their profit. And then as we look down this cash flow statement, they are making adjustments to their income for cash expenses and non-cash expenses. So if they are adding money back in, like right here, amortization, this was a non-cash expense. So when a company has depreciation, here's another one right here, depreciation and amortization, this is where they are smoothing out a loss over a long period of time. So let's say I buy an expensive piece of equipment that has a useful life of 20 years. I will spread out the expense, the depreciation of that equipment over a 20-year period. So I'm showing a small loss every year for 20 years, but it's not actually cash that's leaving my business. And so it gets added back in here. And then every 20 years, I'll have a big capital expense whenever I replace that piece of equipment. So the cash flow will be a little bit more lumpy, and then the earnings, they smooth it out. So amortization, it gets added back in, accrued interest, gain on extinguishment of loans, amortization of deferred loan costs, debt insurance issuance costs, provision for credit losses. So right here. So this is where this is cash that gets added back into their net income. So when they calculate their net income, they take their revenue, they remove $157 million in 2024 for losses that they think they're going to have. But this isn't actually cash leaving the bank. This is future losses that they think they're going to have in the future. So all of this cash is getting added back into the cash flow statement. And so we get to the bottom of their operating activities, and this company had $265 million cash come in, $265 million more cash went in from their operations than went out, even though they only had a net income of $77 million. So this is the difference between the income and the cash flow. So the cash flow, they had $265 million come in. Where did they have cash leaving? Let's go to the investing activities. So from investing activities, they spent $135 million more than they gained from their investments. And if we scroll down to financing, where's financing? Boom. They spent, this is a negative number, they spent $135 million more on financing than they brought in. So they have $265 came into the business from their operations, and then they had 265, basically 135 plus 135 go out. And so then we scroll to the very bottom, we can see the net change in cash. So overall, the company had $4,669,000 leave more than what came in. Okay, I hope that makes sense. So whenever I'm doing evaluation, I'm using the free cash flow. The way free cash flow is calculated is I am looking at the operating cash flow, and then I am subtracting out whatever maintenance expenses they have, which in this case is purchase of property and equipment. So this is stuff that they had to replace. They replace a little bit every year. If we go back in time, so this one right here is 2024. This is 2023. This is 2022. So they spend about $6 million a year on their property, plant, and equipment. And then right here, they had acquisitions, which is loans. So I don't count that as an expense, because when they're loaning money, that is a bank's form of investing in its business, right? They are expecting a return on that investment. So this loans receivable, this is more, they have more loans now. This increase in loans receivable. This is a negative number, because if they have more loans, that means they had more cash going out on loan. Okay. So I'm saying this is a good use of their money, assuming they're doing a good job. They're doing their due diligence. They're loaning their money out to the right people. So 265 million came in. They put 127 million into increasing their loans receivable. I say that's a good thing. Let's look at the financing part of it. So they had to borrow 305 million from senior notes, or sorry, they paid. This is a positive number. So this is money coming into the company. They borrowed money and they paid off debt. So you add the two together, they paid 90 million more than they borrowed. So they had a net repayment of about $90 million. They also had payments for extinguishing unsecured notes. So they're paying back debt. That's another use of their cash flow from their operations. They have other costs with debt issuance costs associated with senior notes payable. They had some proceeds from stock options, and they had some payments related to net share settlement of equity awards. So I'm assuming that's like stock options. I don't really know exactly what that is. And then they had repurchase of common stock. So now we're getting into the cannibalistic nature of this company. So 36 million went into buying back shares. I think that I would call that a good thing. Paying back debt, that's a good thing. Anyway, you add all this up, they had 135 million leaving the company from paying debt and buying back shares. So we see 90 million of it, about 90 million right here, the difference between these two. And then we see 36 million right here. So that's about 126. So the majority of it we see in those two categories. Okay. So that's how they're spending their money. 36 million, that's a lot, but let's put it into context. See 36 million. Let's go to stockanalysis.com and see how much their share count is dropping. So here's shares outstanding. So their share change every year, we can see right here. So over the trailing 12 months, they bought back 6.5% of their total shares. In 2024, they bought back 6%. 2023, 0.5%. 2022, 7.5%. 2021, 4.6%. Anyway, if we go all the way back 10 years ago, or I guess let's not go back 10 years ago, because during this period, they actually had to issue some more shares. But if we just start right here in 2019, if we just start there, for instance, this is in millions, they had approximately 9 million shares. And then we go to today, where they are at, it says 5 million, but it's not doing a good job because it's rounding, but they have a total of 479 million shares. So nearly 50% of their shares since that date that I chose is gone. That's incredibly good progress. They have turned things around amazingly. I don't know if I've ever seen a company that's buying back shares this fast. So this rounds up to 9 million. I don't know exactly what their share count is, but it rounds up to 9 million in 2019. So now we're talking 6 years later, they've bought back roughly half. So if we go back to our table here, they've basically doubled their earnings. And so what I look for, I don't really look for earnings per share. I'm mainly looking for free cash flow per share. So let's look at the free cash flow. How does this show up? So today they've got $48 million in free cash flow per share. And if I scroll back, we can see how this has increased. So 10 years ago, they had 22 million free cash flow per share. So they've more than doubled their free cash flow per share, even though their revenue 10 years ago was 557 million. Their revenue today, 570 million. So even though this company isn't growing in terms of its revenue, it's managed to increase its free cash flow per share by times 2 because they have been buying back all of their shares. Okay. So you might be asking, well, Brian, they're not growing in 10 years. They haven't grown their revenue. Isn't that a bad thing? Yes, that is a bad thing. I don't like that. However, at the end of the day, all that matters is what is the price? Does the share price justify a company that's not growing? Ideally it would be better, yes, if the company was growing. If the company was growing by 10% per year, that would be great. But if the share price was 10 times higher, it would not justify the growth, right? So conversely, if this company was even shrinking, if the share price was low enough, the price could still be undervalued. And so that is what I'm looking at here. This company, a lot of people would skip right over this company. It hasn't grown its revenue in 10 years, basically. Okay, so how do we do that? How do we calculate the free cash flow, the valuation based on free cash flow? So this is my free cash flow automated spreadsheet. Type in the ticker, it automatically brings in a bunch of data. So their past free cash flow margin on average over the last 5 years is 44.5%. Okay, I put in 35. I want to be a little bit conservative here. So I mentioned earlier that they have their net income, and then to calculate the free cash flow, they add things back in like provision for loan losses. And so you might be asking, well, a provision for a loan loss, isn't that something that we don't want to put back into their free cash flow because they might be losing it into the future? So yes, but this provision for loan loss, this is something that they're projecting is going to happen slowly over the course of several years because of loans that they've already loaned this money out. They're thinking they might not get some of that money back in the future. So what I can look at is I can see what is their past free cash flow margin, because their past free cash flow margin would account for money in the past that they added back in for loans. And if they did a bad job of calculating that loan, what's the word I'm looking for? The provision for the loan loss, then we would see their free cash flow margin shrinking over time. Because like if one year if I'm adding back in this provision for loan extinguishment, and then that was a mistake and they end up getting less cash in the future, then we would see a shrinking free cash flow margin, basically is what I'm getting at. But whenever I go back in time and I look at this company's free cash flow margin, what do I see? I see 44 over the trailing 12 months. I see it 46 here. I see it 45. Oh, I see it 40, back up to 45, 43, 41, 43, 35. So actually it looks like it's increasing on average, because if I go back here, 35%, I actually see this free cash flow margin increasing over time. So what I don't see is a punishment in terms of free cash flow margin. So I'm putting in an average of 35, even though I have to go back 10 years before I saw a free cash flow margin of 35, and it's been increasing ever since. So personally, I think putting 35 on a go forward basis is beyond conservative. Like this is a benchmark that the company is likely to exceed going forward. And when I'm doing this valuation, that is what I'm looking to capture. What is a benchmark that I'm confident this company will exceed? And so if I assume that benchmark and I calculate the share price associated with that benchmark, then I can be relatively confident that they'll actually do better than that going forward. Okay. So based on a 35% free cash flow margin, even though their average has been 44, even though they've been growing their revenue over the past 5 years at about 1% per year, I am assuming 0% revenue growth for years 1 through 5, 0% revenue growth for years 6 through 10, 0% revenue growth into perpetuity. So I'm assuming this company just never grows again. They are just churning out the same free cash flow every single year. So I could think of this like, I don't know, like a bond that's just paying out coupons every year or every quarter or however you want to look at it. So a bond never grows, but there is still a price that you would want to pay for a bond. Like if you kept making the bond cheaper and the coupon stayed the same, eventually you'd get to a point where you're like, damn, this bond is actually going to give me more money than any stock in the stock market, right? So even though the company is not growing, if the share price is low enough, it works, okay? So based on these assumptions right here that I've put in, if those assumptions are reasonable, and I want at least an 8.25% return on my investment every year, then the share price should be $350 per share. However, current share price is about 150. So to me, that represents a 140% upside on this stock. It's priced so low compared to its free cash flow. And they're using their free cash flow to buy back shares, which means over time, as the number of shares continue to shrink, the free cash flow per share will continue to rise. And let's look at their, let me hold on one second before I speak. They do not pay a dividend. So eventually, if they did decide to pay a dividend, the money that they would be able to pull from to pay that dividend would be their free cash flow. So currently, they're using their free cash flow to buy back shares. But if they did turn it into a dividend, that would be one way you could look at it in the future. If you were looking to get a big return on that investment in terms of cash, they may, at some point in the future, pay a dividend, especially if their share price is no longer undervalued. So, okay, let's look at their financial, or let's look at their history really quick. If I go back 5 years. Oh, okay. So over the last 5 years, they've kind of been up and down. We had a little bit of they were appreciating a lot going into 2022. And then in 22, we had a little bit of a recession. They've since shrunk, and then they've been just kind of slowly appreciating in value since. So that's their 5-year price history. Okay. On their most recent quarterly report, let's talk about, hold on. Hokage says their earnings per share growth, even though they are buying back shares. Okay, let me look at their earnings per share growth. And remember, I'm more concerned with the free cash flow growth because their earnings are going to be adjusted by different things. But let's here we go. Sorry, forgot where I was going. Let's look at their earnings per share growth as well. Let's see. So going back, it was really low here, fiscal year 2023. And that would make sense because that was coming out of the little short recession we had. But they're about $10 earnings per share, 16 in 2025, 13, 3, 8, 13, 3, 4, 6, 8, 10. So it looks like they were, one way to look at this, you go back 10 years and it was the same exact earnings per share as today. So did they have anything special going on this year that would drop their earnings per share? One sec. Because I thought I saw, maybe I was thinking about on their earnings report. Oh, I remember now. Okay, so I remember they had some additional expenses this year. Hold on. So this is their earnings call transcript. Okay, here we go. So we had a $3.7 million one-time expense from early redemption in our bonds. This accounts for 57 cents earnings per share impact. Second, even though we discontinued and disposed of our Mexico operations, we had a $1.3 million tax-related expense. So that was another one-time expense. The $1.3 million accounted for 26 cents per share. And then there was one other, this marginal increase in provision is solely due to the increased new customer base, approximately 5 million, solely due to the new customers in the portfolio at the end of the second quarter. This represents a 0.78. So they do say that they had 3 unusual events that accounted for 1.61 in terms of their earnings per share. Now that doesn't move the needle a ton. So if we go back, if we just give them credit for the whole 1.6, which I don't know that we should necessarily, but that would bring it up to about 12.3. So it would be slightly higher. I guess maybe the way to look at this is you would look at the average. So the average earnings per share in this 5-year period would be much lower than the average earnings per share on this period. So I would say on average, their earnings per share has been going up, but not as much as their free cash flow per share. So that was an interesting thing to bring up. My bad. I think I saw earnings per share growth, not earnings per share. Oh, okay. Gotcha. Yeah, the earnings per share growth. See, the earnings per share growth is actually pretty spotty. I mean, they had big drops here. That was probably due to the 2022 recession. And then big growth, 266%. So earnings per share has actually been pretty lumpy. But anyway, like I said, I use a free cash flow valuation strategy. So I am more concerned with the free cash flow per share, not so much the earnings per share, because earnings are decreased by things, especially for banks that are not necessarily pulling cash out of the business. So depreciation, amortization, provision for losses going into the future that may or may not happen. And one thing I wanted to look at is past provision for losses. So if we go back, let's see, where is it? Past provision for losses. Where is it? Provision for credit losses. So in 2024, they had 157 million provision. In 2023, they had, 260 million. In 2022, they had 186 million. So this number is going up and down quite a bit. Looks like they may have overassumed this year and then corrected in the next year. So I prefer to just look at what is their historical free cash flow margin. If they're maintaining a certain margin over a 10-year period, then they are doing well enough at having their provision for credit losses. It's not shrinking their free cash flow. In fact, their free cash flow margin is only growing. So I am a fan of, and free cash flow margin, by the way, this is related to their revenue. So you take the revenue that comes in, which in this case is the interest that they're making on their loans. It's the services that they're providing. It could be fees, so it's interest, fees, and then they also provide tax services. So that's their revenue coming in. Their free cash flow is the percentage of that revenue that they're able to hold on to and reinvest in the business. So that free cash flow margin has been going up over the 10-year period. So I feel safe giving them a 35% free cash flow margin. That's a big hit on 44.5. In fact, if I just left it at 44, we would see that the projected upside is much, much bigger. So anyway, 35, 140% upside on this company. They're constantly buying back shares. Their free cash flow margin is constantly going up. I think this is a really interesting company. And I also wanted to point out, so on their earnings call transcript, where they talk about their share repurchase plan, it's only getting more aggressive. So let's scroll down just a bit. Okay. Other great improvements to our capital position include, as we previously mentioned, this quarter we repurchased and canceled the remaining 170 million of our bonds and set up a 175 million warehouse facility. Also in the quarter, we completed a new credit agreement increasing commitments and allowing for stock repurchases of up to 100% of net income, which is an increase from 50% of net income in our prior agreement, and an additional 100 million upfront repurchase allowance in addition to the 100% net income. So, okay, 100% of their income, they're cleared for share buybacks, plus 100 million. Let's put this into perspective really quick. So if I go to the quarterly view really quick, cash flow statement, quarterly view, share repurchase. So in the last quarter, they bought back $66 million in shares. Their income was actually negative for that quarter. They had negative income, but they have the additional the additional 100 million that they are allowing. Or is that on a go forward basis? Hold on. Let me read that again. Oh, in the quarter. So in that quarter, that was the last quarter, they cleared a 100 million upfront repurchase allowance, and looks like they still have 34 million. For that purchase potential, we've already purchased 9.1% of our shares so far year to date, which is around 80 million. With additional capacity, we've repurchased another 77 million this year, or approximately 8.6% of outstanding shares at yesterday's price, for a total potential repurchase of around 17% of outstanding shares. So, this transcript comes out on October 23rd. So, okay. This is as of September 30th. So up to a month after the fact, they're buying back shares that are not reported, that are not going to show up on this column right here. So this Q2 of 2026. So here they're showing 66 million, but it looks like since that was reported, they're saying that they've also repurchased another, whatever, another 77 million. So 17.7% of outstanding shares. I mean, that is insane. They are buying back shares like crazy. That takes confidence. They have to be confident in their performance to put this much money into buying back their shares. That is just insane. Yeah, 100% of income, additional 100 million upfront allowance to buy back shares. Jeez. That's just okay. So compared to their market cap, okay, their market cap is $700 million. So allowing for a 100 million in share buybacks, that's 1/7 of their total shares. I guess that's where they come up with the 17%. That's about 1/7 is less than 17%. 1/7 is like 14%. But so yeah, they're buying back more than 1/7 of their shares in basically in half of a year, in a 2-quarter period. So yeah, this is a cannibal company if I've ever seen one. Yeah, wild. 0% growth, lower free cash flow margin, huge upside. And what are they doing with the money? They're doing 3 things. They're buying back shares, they are paying back debt, and they are increasing their loans outstanding. Let's look at the loans outstanding. So the 6 months ending in 2025, in September 30th, here we go. Originations of loans receivable right here. So this is how much they loaned out. This is how much they were paid back by loans in this quarter. So 12 months previously, they loaned out 626. So this number, the 626 going up to 680, that's nearly a 10% increase in the amount of loans that they have loaned out. So their loan balance going up. They're being more aggressive with the loans they're putting out. Hopefully they're doing their due diligence and, they're not going to have a bunch of credit losses. They did increase their provision for credit losses by about, 10% as well. So it looks like it's a proportional increase. But yeah, so over this last 6-month period, they had $106 million come in from their operations. They spent $149 investing, mainly on their loans. They increased their loans. They also had to spend some money on property, and equipment, sorry, not plants. And then cash flow from financing. They also spent, they actually gained $47 million from financing. So it looks like they borrowed $426 million. They paid back 104 plus 188. So they did take out some more loans in this 6-month period. But yeah, anyway, this company looks really strong. This company is available on M1 Finance. This is my public YouTube portfolio series. Let me pull it up. So I know the last couple weeks since I've been looking at small cap, low volume companies, I have not been able to invest on M1 Finance because they are, they don't have a huge bank of companies that you can invest in for some reason. Not like Charles Schwab, for instance, which Charles Schwab you can invest in pretty much anything, but not M1. Okay, so for this, I invest in a different company every week. I've been putting $100. However, starting January, I'm going to up my weekly investment to $250. So the portfolio has been moving up nicely this year. I've been doing this for approximately 1 full year now. We're up to $6,500. We are currently beating the S&P 500. Let's look at their performance really quick. View the benchmarks. Let's add the S&P on here so we can benchmark ourselves against SPY. So our YouTube portfolio year to date is up 22%. Vanguard Total World is up 20%. iShares Core Growth is up 14%. The S&P is up 15.5%. So fortunately, we are outperforming the S&P 500. So at the beginning of this portfolio, we did not have as many companies that we were investing in. We're invested in 40 something companies now. At the beginning, we were just invested in a few. So you can see we were very volatile at the beginning. And then since then, the portfolio has been more in line with the movements of the S&P 500, but we are outperforming. So that's always good to see. But like I said, so let's look at the holdings this week. I am purchasing $100 of World Acceptance. So that's this holding right there. I haven't put the money in yet, but I will be doing that first thing tomorrow morning. Okay. Hokage says, if you put in market order, your purchase price of this stock might go up a lot because it is extremely low volume. I recommend making a limit order. That is very good advice. 100%. I should have brought that up. 100% right. When you're investing in small cap, low volume stocks, never do a market order. Whenever you're investing in companies that have tons of volume, tons of liquidity, doing a market order is relatively safe because chances are there's going to be plenty of people trying to buy and sell the stock that the market makers can easily just slot you in at a fair price. But with these low volume stocks, there could be a significant spread between the bid and the ask price. The bid price, so if I'm trying to buy a share, I would be putting in the bid price. So this company is at $146 per share. $146. Yeah, so let's say I put in a bid at 146 on the dot. The highest ask price, so somebody asking because they're trying to sell a stock, the ask price could be 147. There could be a huge spread between somebody putting out a bid and somebody putting out an ask. And so if I put in a market order, let's say I put in a market order for 100 shares at 147, let's say there's only 10 shares that are making up the ask. So 10 of my shares get bought at the ask price, and then there's still 90 shares open and there's no ask. And so since I haven't specified a price that I'm willing to pay, somebody could put an ask in there for like $500, theoretically, and then I would just fill my order at $500 because I didn't specify what price I was willing to pay. So I hope I explained that well enough. Hokage said on HGBL, I did a limit order from last week. Nice. Yeah, very good. Yeah, I should have. I'm glad you brought that up. I should have explained that potential risk when buying low volume stocks. That's a great thought. Okay. So that is all I wanted to talk about in terms of this week's investment, World Acceptance Corporation. So just to put this into context, this is a relatively risky stock. It's doing loans to people that have a hard time getting loans. So keep that in mind. If you are investing in this stock, you definitely want it to be a low percentage of your total portfolio. Now, with a company like this, there is a significant potential upside, a significant upside. So it is worth the investment. But with the power of diversification, you want to not just put all your money into one or two of these high risk, high reward companies. You want to spread them out over several equally awesome undervalued companies. That way, if one or two of them, something bad happens to the company, because it is small, it is relatively risky. Something bad could happen. They could, theoretically go out of business. You don't want your entire portfolio to get decimated, right? You want to have lots of high conviction stocks, especially when you're looking at deep value stocks, especially when you're looking at small cap, low volume stocks. Okay, that's my spiel on diversification. Now, I want to do, I'm getting a little bit ahead of myself because I do have a video coming out on this, but I want to go a little bit into the cannabis scene. So let's see, how do I want to do this? Well, first, let's look at the portfolio. So number one holding, PLAB. We got Google, ASML, British American Tobacco, Genmab. These are all companies that are up 50% or more. Whenever I've held these companies for at least a year, I'm going to do a review on all these companies that are up significantly and see if any of these are needing to be trimmed or just sold off completely. So if a company, so I run the same exact drill on a company that I've already invested in. I do the discounted free cash flow model. If they're overvalued, I trim them or sell them. But I want to wait until 1 full year. That way I don't have to pay capital gains. I pay long-term capital gains, because whenever you're paying capital gains on a stock, short-term capital gains, it really cuts into your gains quite a bit. And so if a stock is slightly overvalued, the act of selling it cuts out a lot of those, a lot of the gains that you would get. And so whenever you sell a big winner, you want to have extra conviction that there's another play that you have or another investment that you have that is going to be performing that much better to account for those tax gains. And then if I can match them up with a similar company that I no longer like, then that would be ideal. However, maybe I would do CoreWeave, because CoreWeave I don't have the highest conviction on. This was a high risk, high reward company. So I may pair selling some of those with trimming a company like CoreWeave. However, Simply Good Foods and Nice, just to name these two. I have to look into Iridium again. But these two for sure, I think these are still very undervalued, strong companies. So these I would not sell off, even though they're down quite a bit. PayPal down quite a bit. This is another great example of a cannibal company. And I've doubled down and tripled down on PayPal. Uber I've doubled down on, even though it's kind of low. So that's really the idea here is sometimes a company drops a whole lot for a reason, and the company is now no longer undervalued. It's just a failing company. Those you just cut your losses on. Okay, Hokage says you might have to wait longer than 1 year for the companies you doubled down on. Yeah, that's true. That is true. I may have to. Now, if the company is insanely overvalued, then that's a different story. So let's say, short-term, let's say my short-term capital gains tax bracket is in the, 22%. Let's say it's at 22%. If the company is 60% overvalued, then I might as well go ahead and capture that gain now and just accept, the tax. So that was something maybe I should have done with, where is it? Hims, because Hims was up by an insane amount at one point, and I wanted to wait until a year, but I waited, and it has since come down quite a bit, and now I don't know that I would trim it at all. So that strategy doesn't always work out, trying to avoid the long-term or the short-term capital gains, but it is something that I try to be mindful of. So anyway, we are at 43 different companies. That is another aspect of this YouTube portfolio that I might have to rethink, because as the number of companies goes up, it becomes more and more difficult to stay on top of all these companies. So when a company does become overvalued, it's more difficult for me to catch it and then drop it out of the portfolio. So my portfolio returns will suffer by having so many, but I do want to have a healthy number. Okay. Hokage, before I look into some cannabis companies, do you have any companies that you want me to look at? If you do, I would be happy to give them a quick check on the discounted free cash flow spreadsheet and just on a surface level, look through them really quick. But while you're thinking about that, let me pull something up. GTBIF. So Trump, basically, he made an announcement or the White House made an announcement that at I believe it's 1:30 Eastern time tomorrow, that Trump is going to make a statement on the future of cannabis. He's been dropping lots of hints lately that cannabis should be rescheduled to 3 so that he can unlock medical research. While cannabis is Schedule 1, it makes it very difficult to do research. If it were rescheduled, lots of money would pour in so that we could look into the medical potential of cannabis, which we have already seen with the limited research that we have done, that cannabis does have significant medical potential. So one of the other effects of that, of making it Schedule 3 is it makes it to where legal state-run cannabis companies, or sorry, not state-run cannabis, but cannabis companies that are in states where cannabis is legal, right? Because some states have legalized medical cannabis, some states have legalized recreational cannabis, some states still have it completely illegal. And so there's a little bit of a disconnect between the federal government and what a lot of the states are doing. So where cannabis companies are operating legally within a state, they currently have to pay very high taxes federally because cannabis is a Schedule 1 drug. So when it goes to Schedule 2, these companies pay much less in taxes. So with Green Thumb, for instance, if I go to the income statement, we can see that even though they only made $180 million, they still had to pay $133 million in income tax. The corporate tax rate is supposed to be 21%. So their tax was supposed to be closer to, 33 million, not 133 million. So their free cash flow is going to go way up. And after doing the free cash flow spreadsheet, I put the fair value of Green Thumb around $13, $14 per share. So even though in the last 5 days, Green Thumb has gone up 54%, I think it's still a relatively undervalued stock. And I still hold Green Thumb. I have not sold any of my Green Thumb yet. However, what I believe to be the safest cannabis company is New Lake Capital Partners. In the last 5 days, it has only increased by 8%. So this company benefits quite a bit from cannabis rescheduling. However, it does not directly get more revenue in the form of like better tax treatment because it doesn't actually sell cannabis. This company just rents real estate to cannabis companies. So they make lease money on tenants. And if the tenants are much more secure in their operation because they're paying less tax, then it makes New Lake Capital Partners less risky. So this company is becoming, or assuming, hey, if we assume that Trump does reschedule, because nothing is confirmed yet, nothing is guaranteed. If we assume that Trump does reschedule, then New Lake Capital Partners tenants suddenly get much more reliable. Now, currently, they pay a 12.43% dividend, which is incredibly high for a real estate investment trust. They normally hover around 6%. So that just goes to show that this company is so cheap right now because it is perceived to have a lot of risk associated with a Schedule 1 narcotic being like kind of the cornerstone of their business. But if that risk goes away, I think we could see this company doubling in value so that it's paying less than a 12.5% dividend. And in the meantime, I'm happy to receive a 12.5% dividend because from what I can tell, even though this company is operating in a Schedule 1 industry, they do a good job of keeping their balance sheet very secure, very safe, and their dividend is very safe. So if I look at their funds from operation, in 2024, their funds from operation was $1.97 per share. Their adjusted funds from operation, this is actually the number that's more accurate, 2.08. Their dividend per share was 1.7. So they're only paying out about, payout ratio. They're paying out close to 80% of their funds they're paying out in the form of a dividend. So if they lost 20% of their tenants, they could still afford to pay their current dividend. Also, I really like their balance sheet. They have in cash $23.5 million. Their total debt is only $7.5 million. So they've got plenty of cash to pay off all their debt. I think this company looks really strong. It's probably not going to pop as much as some of these other cannabis companies like Tilray we talked about earlier. In the last 5 days, Tilray has gone up 56%. You're not going to see a pop like that in the near future. But if Trump does not reschedule, then you're going to see this company just go way down and there's no dividend to back it up, right? Whereas New Lake Capital Partners, it'll probably go down in share price as well. But currently, their dividend is well covered. And as long as their dividend remains healthy, it is a strong anchor for their share price, because if their share price continues to drop, then their dividend yield continues to go up. So That'll bring investors in eventually. There eventually becomes a floor where the dividend is just so high. And if it's well covered, then investors are going to put money in and it's going to keep the share price from falling too low. So anyway, that's all I got for tonight. Okage, thanks for showing up, man. I appreciate you. I hope you enjoyed my presentation on World Acceptance Corporation. It's an interesting one. Incredibly undervalued, big time cannibal, buying back half, reducing, basically reducing their share price, their share count by 50% in 6 years, and approving 100% of their future income, approving all of that for share buybacks plus an extra 100 million. This company is a cannibalistic machine. So $100 for the YouTube portfolio going into World Acceptance Corp. All right. That's all I got. Hokage, take it easy. I'll see you next week. Good night. And I'll catch you next time. World feels similar to USNA plus Cannibal. Yep. Usana. How is that one doing? I don't recall looking at Usana in a while. Is that one in the red? Oh yeah, big time in the red. USNA. Let's see. Free cash flow margin. Call it 7. Yeah, this one is significantly undervalued, assuming 0 growth. But anyway, yeah, that's all I got for tonight. Maybe next stream I will go back over this company because it has dropped quite a bit in the portfolio. It needs to be re-reviewed. We'll do a review of this one at the end of next week's. So anyway, good night, Hokage. I hope to see you next week. And anyone else who's watching, thanks for tuning in. Catch you later.